Welcome to this explainer. Okay, be honest. Have you ever opened up a financial chart and just felt completely, utterly overwhelmed? I mean, you see these jagged lines, weird shapes, and colors just bouncing up and down, and it feels incredibly complicated. It's totally normal to feel like you need an advanced finance degree just to understand what's even happening. But what if we could actually decode those charts into plain, everyday language together? Today, we are going to stop guessing and start actually reading the market. It's such a common frustration. You look at the screen and you're probably wondering, am I literally looking at an alien language right now? All those red and green lines jumping everywhere can definitely make your head spin. But here's the secret to making sense of the whole shebang. The chart isn't just random math, it's actually a visual battlefield. Every single mark you see represents a fierce, real-time fight between two sides. You've got buyers who want the price to go up and sellers who desperately want the price to go down. Once you realize you're just watching a massive tug-of-war, everything changes. Okay, let's dive into this. Here is our roadmap for today. We'll quickly start with the language of the chart, then look at the psychology behind the candle, explore two massive reversal signals, the engulfing pattern and the hammer pattern, and finally, we'll see why context decides everything. Alright, section 1, the language of the chart. Let's learn the alphabets. Look, if you want to read a book, you have to know the alphabet first, right? Well, in financial markets, our basic alphabet is the Japanese candlestick. It's basically a visual summary of how price moved during a specific time frame, whether we're talking about 1 hour or one whole day. Now, the candlestick gives us 4 crucial data points. First, you have the opening price, and finally, the closing price. That thick rectangular area you see between the open and the close, we call that the body. Above and below that body, you'll spot these thin little lines called wicks or shadows. Pay super close attention to those thin wicks, guys. They are literally the scars of extreme battles left behind by the extreme highs and lows before the price was violently pushed back. Moving on to section 2, the psychology behind the candle. This is where we figure out who's actually winning. Now that we recognize our basic alphabet, we need to start reading the psychology, because reading charts isn't just about memorizing some random shapes. It's about figuring out which side is currently winning the war. And it all starts with color. If a candle closes higher than it opened, it's usually colored green. This instantly tells you that the buyers pushed the price upward and completely crushed their opponents during that specific session. On the flip side, if the candle closes lower than it opened, it's red. The sellers absolutely dominated. So a simple glance at the color sequence tells you who is in the driver's seat. If you see multiple green candles in a row, the buyers are in absolute control. Let's see how this actually builds into real market sentences, starting with a really interesting pattern called the harami. Harami is actually a Japanese word meaning pregnant. Notice how a tiny little baby candle is nestled entirely inside the previous large mother candle. This represents a massive decrease in market momentum. The side that was so aggressively pushing the price has suddenly lost their breath. It's a moment of truce, it's a dramatic pause, and a state of equilibrium. Basically warning us to get ready because the next big breakout is coming. Alright, section 3, the engulfing pattern. Get ready for a total power shift. But what happens when that piece is violently broken? To truly understand the market psychology here, we really have to look at this profound quote from Munehisa Homa. He's the legendary Japanese race trader who literally invented candlestick analysis. He said, when one day swallows another, the market's heart has changed. I mean, it sounds super poetic, right? But it perfectly describes the brutal reality of an engulfing pattern. It happens when the side that was completely losing the battle suddenly stages a massive, overwhelming ambush, completely erasing the previous day's progress. Now, what's really interesting about this side is breaking down that psychological shift. Let's look at a bearish engulfing setup. Buyers are pushing the price up, they're feeling super confident. But the very next session, boom, a massive red candle opens higher, then aggressively drives the price down, completely swallowing the previous green candle's body. The psychology here is pure shock and awe. The sellers didn't just fight back, they entirely absorbed the buyers. This signals a total transfer of power and is a massive, massive warning that a downward trend reversal is imminent. Section 4, the hammer pattern. This is all about violent rejection. While the engulfing pattern needs 2 whole candles to tell its story, the hammer does it in just one thrilling setup. The secret to the hammer is a concept called price rejection. Imagine the market is dropping. Sellers are totally in control, pushing the price deep into the red. But suddenly they hit a brick wall. Buyers aggressively step in and violently push the price all the way back up, forcing the candle to close right near its open. What is left behind? A very long lower wick. That wick is the literal scar of a failed attack. It proves that sellers tried to crush the price, but the buyers fiercely, aggressively rejected them. We can see this dynamic so clearly when we compare the hammer with its exact opposite, the shooting star, or Nagaraboshi. The hammer forms at the absolute bottom of a downtrend. Its long lower wick is basically screaming that buyers are refusing to let the price fall any further. Conversely, the shooting star forms at the top of an uptrend. Its long upper wick shows buyers tried to push the price to new highs, but sellers violently swatted them right back down. These long wicks are your massive psychological warning signs that the current trend is completely exhausted. You know, market psychology can get even more devious, like we see right here in the fakie setup. Remember that harami pause we talked about earlier? Well, sometimes the market will actually break out of that pause in one direction, completely tricking impatient traders into jumping in. But right before the candle closes, the price snaps violently back in the opposite direction, leaving a massive long wick behind. What just happened? Well, it's a literal trap. The traders who guessed wrong are now stuck, and as they scramble to exit their positions, they end up feeling a massive, violent reversal in the opposite direction. Finally, Section 5, Context decides everything. Why location matters more than anything. So, we know the alphabets, right? And we totally understand the intense psychology behind these key reversal patterns. But we are missing one final, absolutely crucial piece of the puzzle. Let me ask you a question that frustrates almost every single new chart reader. Why do textbook candlestick patterns sometimes just fail? I mean, you spot a perfect engulfing pattern or a beautiful hammer with a super long wick, just like we discussed. You anticipate the reversal, but then the market just ignores it and keeps on going. Why does the exact same pattern work like absolute magic one time, but completely fail the next? The answer is confluence. Here is the big twist, guys. A candlestick pattern by itself is just a signal. It tells you what is happening, but it doesn't tell you where it's happening. A bearish engulfing pattern floating out in the middle of nowhere, that's weak. It's a really low probability setup. But if you see that exact same violent shift in psychology happen right at a major historical ceiling, a known level of resistance, suddenly you have confluence. The signal perfectly aligns with the location. That is when the pattern becomes a highly probable setup. It's a real game changer. So, the crucial point is this. Reading charts is all about piecing the whole story together. Every single candlestick summarizes the ongoing, brutal battle between buyers and sellers. Powerful reversal patterns like the engulfing candle and the hammer reveal sudden, violent shifts in that core market psychology. We learned that those long wicks aren't just random lines, they are the literal scars of price rejection. But above all else, please remember that the pattern is simply the language. The location on the chart is what provides the necessary context. The next time you open up a chart, I really want you to look past the overwhelming red and green lines jumping around. Look for the battles, look for the exhaustion, look for the traps. Because the market isn't just some random math machine, it's a living, breathing reflection of human psychology. And now that you actually have the tools to decode it, the question is, are you ready to finally stop playing guessing games and start speaking the market's true language? Thanks so much for joining me on this explainer, and keep studying those charts.